Welcome to this explainer. We're going to slice right through the dense financial jargon of Citigroup's Q2 2026 earnings report. We're here to reveal the core story behind their massive revenue surge, unpack the reality of their credit portfolios, and see exactly how they're rewarding their shareholders. If you've been following the banking sector, you already know Citi's been on this multi-year transformation journey. Well, based on this quarter, the numbers suggest that the engine is finally roaring.
Okay, here's our roadmap. 1. Best revenue in a decade. 2. The 5 interconnected businesses. 3. Managing U.S. consumer credit. 4. Rewarding the shareholders. And 5. Looking ahead to 2026.
Section 1. Best revenue in a decade, breaking down the massive headline.
Listen to this powerful opening statement from CEO Jane Fraser. She says, with net income up 45%, this was Citi's best quarterly revenue in a decade with double-digit revenue growth for the firm. That immediately establishes the unprecedented stakes and success of this quarter. When the chief executive of a massive, globally systemically important bank calls it the best quarterly revenue in a decade, that's a huge signal. It tells us that the heavy lifting of their recent structural overhauls is actually starting to translate directly into bottom-line performance. Just look at the sheer scale here. $24.8 billion in total revenues. That marks a massive 14% year-over-year jump. In the world of mega-cap banking, a 14% top-line expansion in a single year? That is absolutely monumental. And the best part? It wasn't just isolated to one lucky trade or a single division. This growth was supported by serious momentum across their legacy franchises and core business units. And that's even factoring in foreign exchange translations.
So the really vital concept to grasp here is what we call positive operating leverage. Essentially, they grew their revenues at 14%, which is significantly faster than their expenses, which only grew by 5%. This kind of strict discipline improved their efficiency ratio by roughly 530 basis points year over year, bringing it down to about 57.4%. What you really need to take away from this is that when revenue outpaces expenses this aggressively, the extra cash just flows straight to the bottom line. That dynamic ultimately drove their earnings per share up by a staggering 61% to $3.15 per share. Just incredible.
Section 2. The 5 interconnected businesses, where the growth came from. What's really fascinating here is how incredibly broad-based this victory was. Across the board, 4 out of their 5 core divisions posted double-digit revenue increases. Services and markets saw massive gains, generating $6.4 billion and $7.0 billion respectively. But the real showstopper, that was banking, jumping an impressive 34% to $1.9 billion. Even the U.S. consumer cards division managed to eke out a 1% gain. Honestly, this is exactly the kind of thing investors dream of seeing. A diversified financial institution firing on almost all cylinders simultaneously.
To really highlight the absolute standouts, let's drill down into some specific metrics. The services division achieved its highest quarterly revenue ever. They generated an incredible return on tangible common equity, which is a key measure of profitability, of over 30%. That is a highly efficient use of capital right there. Meanwhile, markets saw equities revenues shoot up 45%, fueled by record prime balances that surged nearly 60%. That's just a staggering jump for a single year. And over in banking, investment banking revenue shot up 44% as debt and equity capital markets activities came roaring back to life. In fact, Citi played a role in the majority of top equity and debt issuances this quarter.
Section 3. Managing U.S. consumer credit. The reality check.
Okay, we need to take a slight pivot here because the consumer is definitely facing some pressure. The rate of people falling 90-plus days behind on their payments shifted up to 1.21%, and the net credit loss rate, which is essentially the money the bank assumes it simply won't get back, moved to 4.01% for the quarter. Now, while these numbers aren't exactly signaling a total catastrophe, they do clearly indicate that the everyday consumer is feeling the weight of the current macroeconomic environment. And because of that, Citi has to be highly disciplined in how they manage their risk.
So, what does that mean in practice? Well, that data led directly to a $1.6 billion provision for credit losses in the U.S. consumer cards segment alone. If you're not familiar, a provision is basically the bank setting aside capital today to prepare for future potential defaults. Yeah, it's a drag on current earnings for sure, but it's an absolutely necessary shield for the balance sheet.
The absolute main takeaway here is that this $1.6 billion provision isn't a crisis, it's calculated preparation.
Think of it a bit like buying a bigger umbrella because you invited more people to your outdoor party, right? If you issue more credit and overall credit card spending goes up by 15%, your total expected losses are naturally going to rise too. The real drivers here are those changing macroeconomic variables combined with that higher overall card spend volume. Fortunately, though, this was offset slightly by some underlying portfolio quality improvements.
Section 4. Rewarding the shareholders. What happens to the cash?
So, Citi has outlined a very deliberate action plan for their capital returns, and it's backed by a strong Common Equity Tier 1 ratio. That's essentially the bank's core financial shock absorber, and it's sitting pretty at 12.8%, which is well above regulatory minimums. So here's the plan. Step 1. They executed $4.0 billion in common share repurchases just in Q2 alone. Step 2. They announced a 12% quarterly common stock dividend increase starting in the third quarter of 2026. And Step 3. They remain firmly committed to executing against the massive $30 billion buyback plan they announced back in May, and they fully expect those buybacks to accelerate. This is where you see their immediate commitment to investors. When you combine those dividends and share repurchases, Citi hit an incredibly high 92% payout ratio for the quarter. That means 92 cents of every single dollar of net income they generated was handed directly back to shareholders. Honestly, this is exactly how management proves that their whole transformation isn't just about corporate vanity. It's about generating tangible, durable results for the people who actually own the stock.
Section 5. Looking ahead to 2026. Targets and expectations.
Looking forward, management remains fiercely committed to improving long-term returns. Their full-year 2026 guidance targets a 10 to 11% return on tangible common equity. To actually hit that, they plan to strictly hold their efficiency ratio right around 60% to make sure costs don't spiral out of control. On top of that, they're guiding to grow net interest income excluding markets by about 5 to 6%. They're really banking on continued momentum across their fee-generating services and wealth management divisions to make that happen.
As we wrap up this explainer, the big thing you should take away is that Q2 was a phenomenal, maybe even historic quarter of broad-based growth and highly disciplined expense management for Citigroup. But, it does leave us with a pretty compelling question. With record revenues secured and an aggressive shareholder return program underway, can Citi actually maintain this incredible corporate momentum against a shifting consumer credit landscape throughout the rest of 2026? It's a tricky balancing act, and it's absolutely going to define the rest of their fiscal year. Thanks so much for joining me for this explainer, and remember to always keep questioning the numbers.